Welcome to the Deep Dive. We're here to cut through the noise of complex financial news and give you the essential insights you need, drawing from key reports, particularly today from the Seoul Economic Daily.
Absolutely. And today, we've got quite a contrast. We're diving into two very different ends of the financial spectrum in Korea.
Oh, yeah. What are we looking at?
Well, first, a really concerning issue on the consumer level, a, let's say, systemic problem in the used car market that's costing people billions.
Billions. Okay, that's definitely something we need to unpack. And the other end?
And then, shifting gears completely, we'll look at the big picture, the strategic moves happening within major financial groups like Woori and BNK. Think internal stability, capital strategies, that kind of thing.
Got it. Micro-level consumer pain versus macro-level corporate strategy. Let's definitely start with that used car situation. You said billions lost. That sounds like more than just a few bad deals.
Oh, much more. We're talking about the performance and condition liability insurance. It's mandatory, supposed to protect used car buyers.
Right. I know the one. So what's the problem?
The problem is the cost and who's paying. Between March 2023 and February 2024, consumers paid out over 86.4 billion Korean won for this insurance.
86.4 billion. Wow. Okay. And is that like a normal amount?
Not really, and it's growing incredibly fast. That figure is up 21% from the year before. And get this, back in 2020, the total was 30.9 billion KRW.
So it's nearly tripled in just 4 years.
Exactly. Nearly
Right.
tripled. That's not just, inflation. That signals a serious breakdown in how this is supposed to work.
So why? Why is this happening? What's the mechanism here?
Okay, so the insurance itself, it's been required since 2019. It covers differences between what the inspection report says about the car and, well, the reality, which sounds fine, right?
Yeah, sounds necessary even.
But here's the flaw. A government memo, also from 2019, basically allowed the companies doing the inspections, the ones checking the car's condition, to charge the insurance premium directly to the buyer.
Wait, the buyer pays the insurance premium even if the inspection company says the car is perfect.
Precisely. And think about the incentives there. If you're the inspection firm and you know the buyer pays the premium no matter what you find or don't find.
Then why bother being careful? You just push the car through, collect your fee, and the buyer covers the insurance risk.
It's a classic case of moral hazard baked right into the system by that memo. There's basically zero financial reason for the inspection firm to do a thorough job.
And I bet we see the results of that in the numbers.
You certainly do. The overall insurance accident rate, basically, how often claims are made because the inspection missed something, it's jumped, went from 2.74% back around 2020 up to 4.31% now.
That's a huge jump. It suggests the inspections are getting much worse.
Absolutely. Less reliable inspections lead to more claims, and more claims mean
Higher premiums for everyone.
you got it. Since 2020, the average premium for just a regular domestic passenger car, it's gone up 2.5 times.
2.5 times. And is it the same across the board?
No, and that's another kicker. For a domestic car, the average premium is around, say, 58,690 KRW. But if you buy an imported car, you're looking at something like 227,539 KRW.
Whoa, that's a massive difference. And again, the buyer is footing that bill entirely.
Entirely. It's just astonishing this setup is still in place, given the rising costs and, frankly, the obvious unfairness.
It really is. And who's actually benefiting here? If consumers are paying way more, and you mentioned inspections are less reliable, are the insurance companies making a killing?
Well, that's the strange part. No, not really. Their loss ratios are actually quite high, near 70%, meaning they pay out a lot in claims. But, and this is key, they also pay out huge fees, something like 35 to 40% of the total premiums collected, to the repair shops and brokers involved in the process.
Oh, okay. So even if the insurers aren't directly profiting hugely, there's a whole ecosystem in the repair industry, the brokers getting a guaranteed cut from these inflated premiums.
Exactly. And that structure creates, a strong incentive for them to keep things as they are.
Yeah.
So even though politicians have called for reform, the actual government bodies responsible,
The Ministry of Land, Infrastructure, Transport, and the financial authorities.
yeah, them, they haven't really acted decisively. It's stuck.
So if we know the problem and the perverse incentives, what's the fix everyone is pointing to?
It seems pretty straightforward, legislatively speaking. You just need to change the rule. Make the performance inspection business, the ones doing the check, the party that has to pay the premium.
Right. Put the financial risk back on the entity responsible for the quality check. That would immediately incentivize them to be thorough.
Absolutely. And alongside that, the financial regulators really need to overhaul the whole rate calculation system. It's clearly not working. The current system basically rewards sloppy work, and the consumer just keeps paying more and more.
It really damages trust in the whole market, doesn't it? Okay, let's shift gears now. That story is one of kind of regulatory failure and misaligned incentives hurting consumers.
Right, a failure at the micro level, you could say.
So let's contrast that with what's happening at the macro level in the established financial sector. You mentioned proactive strategies, big banks trying to stabilize things.
Exactly. We're seeing a big push from the government for regional financial groups, think B&K, JB Financial, IM Financial, to really step up and lead in what they're calling productive finance.
Productive finance, what does that mean in practice? Just lending more?
It's a bit more targeted than that. It's about using their financial power strategically to tackle bigger issues like regional economic imbalances, population drain from certain areas.
Okay, so how are they doing that? Are there concrete examples?
Yeah, definitely. Take B&K, which is vital for the Southeast region. They just launched a Think Lab focused on maritime finance. They even partnered with the Ministry of Oceans and Fisheries.
A Think Lab, so research and development for financial products.
Kind of. It's about building expertise and financial tools, specifically for key regional industries, maritime, defense, energy, things that are crucial to that area's economy.
Yeah.
The idea is to channel capital effectively to support those specific sectors.
Makes sense. Target the investment where it boosts regional strengths. What about the others? JBIM.
Similar focus, different angle. JB Financial set up a productive finance consultative group. They're working closely with local governments, really zeroing in on specialized lending for small and medium-sized enterprises, SMEs.
Right, the backbone of many local economies.
Exactly. And IM Financial, that used to be Daegu Bank, they're doing similar work, supporting local startups and SMEs in their region. Daegu Yongbuk.
Okay, so these are important initiatives for regional balance, but you mentioned something about stability being key.
Yes, absolutely critical, because these productive finance strategies, they're long-term plays. You can't make them work if the bank's leadership is constantly changing, You need stable governance. Management continuity is paramount.
And we've seen issues with that recently.
Well, the controversy around picking the new chairman at B&K highlighted that exact challenge. It creates uncertainty. You can contrast that with, say, KB Financial Group. They had the same leader, Yoon Jong-kyu, for 9 years. That kind of stability makes a huge difference.
Predictability. Investors like it, regulators like it. It allows for long-term planning.
Precisely. Constant turnover leads to short-term thinking, which can undermine those big regional development goals they're supposed to be supporting.
Speaking of stability and getting things in order, let's talk about Woori Financial Group. They had a really significant internal development recently, didn't they? Something about alumni group.
Oh, that was huge. Symbolic, but also deeply meaningful for their internal culture. They finally, after 26 years, unified the alumni associations from the two banks that merged to form Woori, the old commercial bank and Handel Bank.
26 years. Wow. These were separate groups inside the same bank all that time.
Yes. They were often known informally by their old headquarter locations, the Hyojidong Association and the Yujiro Association. And their separateness really symbolized these long-running factional conflicts. Gipagoldum is the Korean term, deep divisions.
And those divisions weren't just like social clubs, right? Analysts often pointed to them as a source of real problems.
Definitely. They were blamed for everything from just internal friction, slowing things down, to more serious issues over the years like problems in recruiting, even issues with improper loans linked to factional loyalties.
So for a quarter of a century, internal politics were a major drag.
Pretty much. So finally merging these groups, achieving this chemical merger, as they call it, is a massive step. It's widely seen as Chairman Lim Jong-rong really getting that done. It signals Woori might finally be ready to put that internal stuff behind them and focus purely on competing externally.
A unified front, finally. But like you said, internal culture is one thing. What about the hard numbers, the financial strength? Woori has faced some challenges there too, right? Specifically with capital.
That's the other major piece of the puzzle for them. Their capital adequacy ratio, specifically the Common Equity Tier 1 or CET1 ratio, needs attention. It's currently sitting at 12.92%.
Okay, let's quickly break that down. CET1, that's the core measure of a bank's ability to absorb losses, right? The best quality capital.
It's the bedrock capital buffer. And Woori's 12.92%. Well, it's the lowest among the big four financial groups in Korea right now.
And being the lowest puts them under regulatory scrutiny, I imagine.
It does, especially since they recently made the conditional acquisition of Dongyang and ABL Life Insurance. The regulators looked at that and basically said, okay, fine, but You really need to show us a solid plan to boost your capital. It directly affects their ability to make big strategic moves like M&A.
So how are they responding? Are they boosting it?
They're moving quite aggressively, actually. We saw them sell off their Ansong Training Center much earlier than planned. It was supposed to be sold maybe in 2026. They did it now, brought in tens of billions of KRW.
Hold it forward to get that capital onto the books quickly.
Right. A direct injection of high-quality capital.
Right.
And it doesn't stop there. They're speeding up sales of other unused properties, old branches, a sports field they owned, getting rid of non-core assets.
Any other levers they're pulling?
They're also looking at reassessing the value of some of their existing assets, which, depending on market conditions, could also help improve the capital ratios on paper by reflecting current, perhaps higher values.
So it's a real push on multiple fronts. Sell assets, maybe revalue others, all to strengthen that CET1 ratio.
Yes. It's about solidifying their position among the Big Four by tackling the internal cultural issues and the external capital requirements at the same time. They're trying to signal they're serious about becoming, a fully unified, robust financial institution ready for the future.
It really is fascinating seeing these different stories side by side. On one hand, you have this major breakdown in consumer protection in the used car market, costing everyday people real money due to, frankly, a poorly designed rule.
A fundamental failure to protect the buyer, really.
And on the other hand, you see these huge financial institutions making very calculated, high-level moves, trying to ensure regional economic health, stabilizing their own governance, fortifying their capital bases.
These two narratives, the consumer frustration where trust is broken and the corporate strategy trying to build strength, they really capture a lot about the current financial landscape, where things are going wrong and where the big players are focusing their energy to shore things up.
And maybe the big question for you, listening to all this, is how these two things coexist. Can the big financial players really achieve long-term stability and execute these grand strategies if the basic trust in everyday financial dealings, like buying a used car, is being eroded by systemic failures? That gap in trust feels like a critical underlying tension. So today we've covered some critical economic ground. The serious problems with used car insurance premiums being passed on to consumers, the growing importance of regional finance and national development, and Wori Financial Group's major efforts to stabilize its management and boost its capital.
A lot of moving pieces in the Korean financial world right now.
Indeed. We'll be back next time with more fast-breaking news and analysis. Thank you for joining us for this deep dive.